Two of the most important factors for a happy retirement are staying healthy and spending your money wisely. But you want to be careful because some people are taking things too far, and the IRS just issued a warning. Some people are saying, hey, staying healthy, that's a health-related thing, so I should be able to pay for my health club membership. I should be able to pay for my health food in pre-tax dollars using my health savings account or my flexible spending account. But you know what? Kind of not surprisingly, the IRS would disagree with you on that. They just issued a bulletin, 2024-65, where they're warning U.S. taxpayers, and apparently there's millions of us doing this, that we're on thin ice if we're doing that. Now, the IRS doesn't make the final decision on this. They do get to do that short term, but long term it goes to tax court, and tax court will decide this. And I think this one's headed to tax court because a warning that the IRS sent out, it was actually just a few days ago as I record this, their bulletin, 2024-65, dated March 6th. And it talks about that there's people that are promoting, hey, you can use your health savings account, you can use your flexible spending account for your gym membership or for special food. And the IRS is sending out this warning and saying, we, the IRS, don't agree with that. And for now, while we get to make the decision, we're saying no. We're saying, no, you don't get to do that, particularly if it's with a doctor's note, as opposed to treating a specific disease. So if your doctor prescribes something, let's say you have diabetes, and Ozempic is a drug that is used for diabetes. It's also used for weight loss. If you get a prescription for Ozempic because you have diabetes, then that's a medical condition. And my understanding is, yes, you can write that off. Now, I'm not an accountant, and it's subject to a lot of limits, including it's 7.5% after your medical expenses. It's after your first 7.5% that you've spent. 7.5% of your adjusted gross income, your AGI. We're going to talk about this more later, but I just wanted to point it out. Here is the actual warning from the IRS. I'll show it here. Now, I'm not an accountant. This is not financial advice. It's definitely not tax advice. I'm also not an attorney, and this is not financial advice for your situation. But I think it's important. I want to put it on your radar screen because I do talk about the importance of staying healthy in retirement. And I also talk about the benefits of health savings accounts where you can put money into a health savings account with pre-tax dollars. In essence, if you could do this, if you could pay for your special food, let's say, with a health savings account, special food for dietary needs, then you could essentially pay for that with pre-tax dollars by putting the money through an health savings account and then taking it out. So let's look at what some of the pundits in the industry say. So this is Intuit, and they have a chart up here, and they have an article on this. So basically, you can see here exactly the example I used with Ozempic to treat diabetes. They're saying, yes, you can. If you itemize your deductions, this can be used as one of the itemized deductions, but again, they give that limit of 7.5% of your AGI. Look at the next question. The next question is, can you use Ozempic for weight loss? Can you deduct it on your taxes? And here they say, although Ozempic is not approved by the FDA for weight loss, many people are taking it to lose weight. In some cases, physicians are prescribing it for weight loss. According to the IRS, weight loss programs just for the sake of losing weight are not deductible unless the program treats a specific disease diagnosed by a physician like obesity, diabetes, hypertension, or heart disease. If your doctor has prescribed Ozempic to help lose weight to treat a specific disease, then you may be able to deduct your cost. Notice they said maybe. So, and then there's another weight loss drug called Wegovy. Their conclusion is the same for that. And it says, however, if you purchase Wegovy because you want to start dropping some pounds, then you likely will not be able to deduct it. But if your doctor's prescribed it to treat a specific disease, you see the commonality here. It's the linchpin, the important phrase is to treat a specific disease that your doctor has prescribed. Now, it's 7.5%, above 7.5% of your AGI, but this is a deduction. So for many, many Americans, we don't itemize our deductions anymore because the standardized deduction a couple of years ago got raised significantly. You can see what that is in 2024. If you're single, your standardized deduction is $14,600. Married filing jointly is $29,200. And if you're a senior, it's an additional $1,550 for married singles for each, and then additional for unmarried. And I'm pretty sure it's 65 is what the cutoff is for, it says seniors. I wish it had the age there. Okay. And so when I talk about deductions, what do I mean by deductions? Well, this article here by NerdWallet has some typical deductions. They would include things like what's typically called SALT, your state and local taxes. And so that's where you can deduct your property tax and either of the next two things I'm about to say. Your state and local income tax or your state and local sales tax. But that's an either or. So that's called the SALT exclusion. And that has a cap of $5,000 a year for a single person and $10,000 a year for a married filing jointly. And then the big one for many of us is our mortgage interest. We can deduct the interest on the first $750,000 of our mortgage. So as I said, many people now, instead of itemizing their deductions, they just take the standard deduction. And for people that don't have a lot of deductions, if you don't own a house already, the increase in the standard deduction was probably a great thing for you. Okay, here's a reminder of how the home mortgage works here. This is from the IRS. This is publication 936. And you can see this is for your primary residence. And you can deduct the home mortgage interest on the first $750,000 loan on your home. However, if you were already deducting mortgage interest prior to December 16, 2017, so if you have an older loan, you could still deduct more than that $750,000. So you can see they changed that. And then, of course, interest rates dropped a lot. So even if somebody had, let's say they had a $1.5 million mortgage and they were paying 6% interest on it, well, prior to that December 16, 2017, they could deduct all of that. All of that interest was a deduction for them. But they probably refinanced that, and if they were able to refinance it down to 2.5%, even though they lost being able to deduct the interest on everything, in that type of example with an extreme drop of interest rates from 6% to 2.5%, they were probably better off refinancing and triggering the new law as opposed to staying grandfathered in the old law. So these deductions, these are what's called below-the-line deductions. So the way tax system works here, I think people will find this interesting, particularly because as I record this, we're in tax season. So you've got your gross income. Here's how you determine your adjusted gross income and then your net taxable income. So you've got your gross income, which is your W-2 interest, your side jobs. For most of us, it's just our W-2 income that we're going to earn, as well as 1099, maybe interest from our local bank or different savings account, long-term capital gains, short-term capital gains, things like that. Now we subtract our adjustments, and I call them adjustments because after this we get to adjusted gross income. And the adjustments for most of us are, so let's say we're making $100,000 a year, but we put $10,000 into our regular 401k. So we put that in pre-tax dollars. The way that happens is that's an adjustment to your income. That the fact that money's not taxed, you make an adjustment. And so now you have your adjusted gross income. So when you make a contribution to a tax-deferred account where you got the tax break going in, then that's the adjustment. So that's your adjusted gross income, and that is a trigger for a lot of tax credits, for a lot of different federal programs. It's all based on what your AGI is, your adjusted gross income. And there we subtract our deductions, which is what we've just been talking about. And there you have a choice you have to make. You're either going to itemize your deductions or you're going to say, I'm not going to itemize, but I'm just going to take the standard deduction. And all of that is going to equal your taxable income. And then the last thing I want to point out is we started this talking about the warning that the IRS just issued, where they did say, you know what, food is not tax deductible. Food is not a drug. By the way, I think they're going to have a problem because there's another section of the government that is saying food is a drug, right? I think it's a good program trying to encourage all of us to eat in a more healthy manner. And that program is somewhere in it is called Food is a Drug. So I think now that the IRS is saying, no, food is not a drug, I think we're going to go to tax court on this and see who ends up winning. And basically what's happened is there are firms that have shot up that you can fill out an online form and you can get an over the internet doctor's note saying, okay, you need low salt food, and therefore my company, which happens to sell low salt food, can accept your health savings account money for this, and the consumer is paying for that in pre-tax dollars, which is what the government doesn't like. So if you're curious, what is the safe harbor? This publication 502 by the IRS is really key. So what do I think on all of this? So, one of the keys to being happy in retirement is staying healthy. I also think one of the keys for a happy retirement is having what I call as worry-free of a retirement as you can. And so I don't want to borrow trouble if I don't have to borrow trouble. So you know what? I'm happy to pay for my low-salt crackers in after-tax dollars. I'm happy to pay for my gym membership in after-tax dollars. The last thing I want to do is cause myself a tax problem. So this is not a political channel, but I do think we want to do everything we can to stay healthy. But, for decades and decades, people have been paying for their gym memberships and their healthy food in after-tax dollars. And as far as I'm concerned, I can keep doing that as well. Also, as far as I'm concerned, you should enjoy your 50s, and until you get to retire, you should enjoy that to the maximum. I think too many of us sacrifice too much along the way. And yes, basically my channel is to encourage people to think about retiring early. I think a lot of people that could retire early just coast through life on autopilot. They don't think deliberately and thoughtfully and recognize the preciousness of the time that they have. Unfortunately, at 60 years old, we have less than 1,000 weeks of healthy, active time in front of us. So I don't think we should coast through our 50s where, we could double the amount of, well, we won't quite double it, but we could substantially increase the number of healthy, active weeks that we have. And those are by far, that's when we have our most energy and our highest level of health and vitality and this hunger to get up and go and enjoy life. And I think if you can afford to retire, you should consider retiring. So enough said on that, but that's what this video is here. I want you to think about retiring as soon as you can. 5 reasons to retire as soon as you can. Thanks for watching this video, and I'll see you in that one. Bye-bye.